Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 20 to 25 minutes or so on Options Guide TV. We're kicking off the week a little bit down, a little bit of weakness. The Chinese economy is back in the news. I guess they were able to discern that there's been issues with the public's debt and the defaults that they're seeing within the banks in China, and that's creating some concern about the markets. That's the only kind of outlier news that I have so far to try to determine why we are down today. Numbers have been good. We actually went in on Friday. We had a very solid up week, and we did a long call spread in the SPX. We rode it throughout the whole week. We ended up actually finishing with both strikes in the money. If you rode it all the way to the end, we would have got out before that. We would have taken our profit and ran before we got to the actual expiration date, more than likely. And then this week, and these are all on paper. Once again, nothing's meant to be a recommendation here on Options Guide TV. We're just trying to learn. I looked on Friday because I wasn't quite sure what I would want to do on Monday. If we wanted to come back and do a rinse and repeat of the long call strategy that we were considering. And I decided, you know what, I think I would rather do something based off of kind of what we're seeing in the charts in the SPX and a bullish strategy, but not as bullish as a long call spread. And if anything, if we were doing the long call spread again, we would put it on today. But we're down 1% in the SPX. We're down about 47 points right now. We've broken down actually below the level that from a couple of weeks ago when we were looking at a few SPX trades of the 45.50 level. Right now we're at 45.47.74. That's where the market is at right now. So we're below the 45.50 level. And I do think that has a little bit of significance. And so we did a skip strike butterfly with calls out of the money. Instead of doing a butterfly for a net debit to the account, which would be the total risk of the trade, we decided to skip a strike in the butterfly. And when we do that, we embed a short call spread. Hang with me here. And that call spread pays for that butterfly. So with that said, we were able to do, I guess in my mind, it's really, you're doing a short spread and putting your hedge in on it, in that we're selling this, hoping to bring in the net credit at a minimum. But if the market starts going up towards our short strike in the butterfly, which is a skip strike butterfly, then we can actually make more than just the net credit. So it's very possible with a skip strike butterfly to sell it for, or I guess in butterfly terms, you would be buying it for a net credit, and the market moves towards your strikes and you unwind it also for a net credit. You put it on for a net credit and you unwind it for a net credit, a bigger net credit actually to the account than you initially put it on for. So it's a very odd trade, a very schizophrenic type strategy. And we're going to look into it a little deeper. Now, this is a little bit more of the advanced side of the Options Guide TV. And then if we have time, we see that Charles Schwab, which is part of our paper trading portfolio, has jumped in price. It made a couple of runs up. A lot of people are saying that just has a lot to do with where interest rates are at and the fact that the 10-year is coming down all the way across the board on all the treasuries. We do have the VIX index spike up a little bit today because, as I said, the SPX is down 1%. And that's a pretty substantial move, especially considering we've had such a bullish market and good outlook from everything that we heard on Black Friday and the retailers, et cetera, et cetera. But the VIX right now is at 1358. So I'm actually going to start just some little fun things to talk about. So before I get to the TradeHawk software, let's start by talking a little bit about the CME FedWatch tool. So let me pull this up 1 second here, and there we are. There we have it. So always love this page. It's one of my favorite bookmarks. It actually gives you a countdown to the Fed meeting, which I just think is fun. We have 9 days until the next Fed meeting, but a lot has happened over the last week, and it has a lot to do with why interest rates are dropping. They all go hand in hand. So I'm going to scroll up here and talk a little bit about how this FedWatch tool works. Okay. So at this point in time, it's showing you that the current rate is 525-550. So that's where we're currently at. It actually in December, which is 9 days away, there's just a small percentage of a possibility of a rate cut, which I just think is funny overall. But if anything, gives you a good feeling that there is not going to be a rate hike based off of where these futures are at. But if you jump out to January, so across here are all the Fed meetings all the way through, all the way through 2024. And if we click on the January meeting on the 31st, we now are seeing a 12% chance of a rate cut in January. And I've been talking about this one in March for some time, but now they're indicating, based off of the Fed Fund futures, here's where the current rate is at, 45.50, that there is a higher probability of a rate cut in March than there is for them to actually sustain. And they're even showing a 5% chance of a 50 basis point rate cut. So we go out to May. Obviously, that grows. We go out to June. It's just a much different picture. Remember, this is the current rate right here. And this is what they're predicting based off of the Fed futures and the way that they're trading, that the Fed is going to react going all the way out to June. A lot of the pundits keep talking about June as a potential rate cut. But this is probably the biggest reason why the financials all across the board have been doing well. So I bring this up as we talk about Charles Schwab because not that long ago, Charles Schwab was trading right around 56. We see now that it's going to be pushing up against our strike price. So we have to go to our paper trade portfolio in order to adjust that. But before, let's go and look at that skip strike butterfly. And I'm going to jump right over to the options playbook right here and just highlight the skip strike butterfly. So let me pull this up in the veteran trades here. Skip strike butterfly with calls. Okay. So this is showing the graph at expiration. On Friday's show, we actually showed it inside the what if calculator on the TradeHawk software. And in here, we now see that this is the layout, and this is why I like to call it a skip strike butterfly. I don't think that is a lot of people call it a modified or a broken wing. I do like the skip strike because we are literally skipping the strike. By doing that, if you think about the fact that we would buy and sell this strike as opposed to skip it, if you sold this strike, you would be embedding a short call spread from strike C to strike D. That brings in risk, but it also brings in a credit. And hence you try to get it done for a net credit. Then on this side of the equation of the profit and loss calculator, you are above the graph, which means that if the market does go down, this is a profitable trade. So to start with, on Friday, if you took the approach that, instead of, there's a couple of ways that you can think of a skip strike butterfly. Okay, you ready? Everybody sitting down? You ready for this? Here we go. You can look at it as, I want to do a short call spread, but I'm a little nervous about the market coming up. So instead of just selling the short call spread and having naked risk of the short call spread going against me, I am going to do a skip strike butterfly and already put my hedge in the trade before the trade starts. It's one way to think of it. Or the other way to think of a skip strike butterfly is I'm going to put this trade on I'm going to do a butterfly, but you know what? I don't want to really pay a net debit to put the trade on. So let's do the skip strike butterfly instead of the regular butterfly. So either you take the approach that you're coming in and you're doing a butterfly, but you want to get it done for a net credit, or if you're the short call trader and you've never done, or a short call spread, short put spread, this trade should be in your portfolio. This should be an interesting alternative. Obviously, you're selling a short spread and paying for a butterfly, right? So you're not going to bring in as much of a credit as if you just sold the short spread outright. But it's more of a trade that you can just put on and just watch it, right? You don't have to adjust it as quickly, but you don't get rewarded. So risk and reward, obviously they're always a trade-off when it comes to trading options in general. All right, so now we're going to run back and we're going to take a second. There we go. And let me see, once I get this up and running here, go back to the TradeHawk software and give me a couple more seconds here. Let me make sure that we have the right expiration dates coming up before I jump back to the main screen here. One second. Quite sure why I can't get all the way down there. Okay, 1 second. One more second here. 50, 46, 70. I'm having issues with my quote today in the SPX. December 8th, 2023. All right. There we go. I got it. Okay. Whew. Sorry about that. I gave you a chance to grab your coffee. Hopefully, this is an option show, so we want you to stay wide awake. So I now have the expirations up. So let me set up this trade. So let's run to the TradeHawk software and let's show it here. And there we go. And so now in this instance, we on Friday, we looked at the 4640s. And let me pull that one up. So this is, we're going to get rid of this. We're going to add it here, and it's going to show you the spread right up here. 4640, that's the one that we bought. 4650, we sold that twice. Then we skipped the 4640, and then we bought the 4670, and then we bought this one. All right. And we're 1 by 2 by 1. Now, we did this for a net credit to the account of 60 cents. Now you can do it for a net credit of 35 cents. Okay, so we're up because the market went down. This is a weird trade, but it does go hand in hand with saying that the main focus, if you take the main focus of this trade as I'm selling a short spread to pay for a butterfly, the short spread is becoming more profitable. And so because of that, we're actually up about 30 cents on this trade. So we did the trade on Friday. Market's down 1% today. This trade is up 30 cents. The total requirement is the width of that short spread, which would have been $1,000. No real reason to alter this trade, if you will. I think we would just let it ride going into it, because now if we throw this into the what if calculator, it does get interesting. Okay, send in the what if. And this will show you that, and I'm going to pull this down a little bit. So this shows you as we do this trade, if the market goes down, this is as of today, by the way. This isn't showing the 60-cent net credit. It's showing what we can get it done right now, which is about 35 cents, which is the midpoint. There's never a guarantee of midpoint prices. I always got to throw these disclaimers in just to be wary. But if we do this, we see that if the market does go from here and it goes straight up, well, to start with, this trade isn't profitable until it is. At expiration, now this trade would be very profitable if it's sitting right at that short strike. So the fact that we woke up on a Monday after putting this trade on a Friday and the market's down 1%, thank goodness we did the skip straight butterfly as opposed to the regular butterfly. Just that simple. 46.50 is where we'd like the market to go to. And if it goes up slowly, that's fine. Each day that goes by, this green line is going to look more and more like the yellow line. It's going to morph into that scenario. And so this really isn't a bad play overall. So because of this, we're not going to put on a long call spread this week. I kind of hinted that maybe we would. So unfortunately, I'm going to jump out of this trade for a second. And let's go back. Let's show the playbook and we'll pull up the fig leaf. So let's go to that strategy. Let's go to the main screen here, if we can. Thank you. And we will go to, once again, the software. We're going to pull up the fig leaf and show that just for a second. Well, I log into the paper trading account. So here is the fig leaf. This is the trade that we have done, and I'll even blow it up a little bit here. And then what we have sold is an out-of-the-money call. We're doing this paper trade portfolio over the next year. We're going to add a couple of positions. We don't want to do more than 6 or 7 positions total. Right now, I think we have 4 on once I go in and look in the account. But the one that we're the most concerned about right now is the financial one. We sold a call recently on Schwab, and the stock has moved very strong to the upside since then, up about 10% since we put it on. And so I'm going to go over the trade software and 1 second here and log out of that position. And then let's get that up and running. So 1 second. Thank you. And we're going to go back and we're going to look to roll our covered call position out of there. Let's bring it back. Go over here. And so now one of the biggest things about managing this portfolio, which does make it tough a little bit, when we're going to try to do a lot of the managing on the show, but there's going to be time to time that I'm just going to have to record it because we do the show 3 days a week. Monday, Tuesday, and Wednesday is when we do the show. So when we do this, the market doesn't always just cater to our Options Guide TV. So we always want to be careful when we're rolling covered calls that it doesn't get too deep in the money. And that's a part inside the options playbook about managing your positions. So if you were to fixate on a strategy, we showed you the fig leaf, and then we would go back in and look at the managing tab, and we would show that tab and about rolling covered calls. And it highlights that you do not want that call option to get that far in the money before you decide to roll. So we don't care about the timing as much as we care about the price. If the stock gets too deep in the money on your call position, it gets harder and harder to roll it for a net credit to the account. All right, so let me take this down. Let's go back over here. 1 second, 2 more seconds. Here we go. And now we have the paper trade portfolio on. Apologize that we had to go here. So let's show the screen. Here we go. All right, so now we're in the paper trade portfolio. We see Charles Schwab is trading at 62.41. These are the in the money option contracts that we own. Caterpillar, Google, Nvidia, Schwab. We need to put a retailer in here. I've been threatening to start researching one to add to the portfolio, but we are now at 64 and the market came off today a little bit. Okay, so we were 63.10 this morning. So let's look at rolling this. Let's see where we're at. We don't necessarily have to do it today because we're down 1% in Charles Schwab, much the same as the market. But let's go and look at our options grid. And we are long here, the 64 strike call with the December 15th expiration. On Caterpillar, we're 252. We're 255 here. So we got 18 days until that expiration. So we're a little close on the Caterpillar, but that's down 1.5% today too. That would have been a candidate for a roll. On Google, we're strong, 128, we're fine, 141. That's the one position that we're down on in general out of the four different stocks that we've put on so far. And in Nvidia, we can go out and sell one. That's right. That just recently expired. So that expired on Friday, and let's go and sell a Nvidia call today. So we'll look at the Charles Schwab one and let's compare. I want to look at that first, and then we'll do the Nvidia call. So here we go. Options grid, 64 strike, December 15th. So in our expirations, we need to go over one more expiration. December, what was our expiration? There it is. All right, December 15th. Expiration, SCHW. We're not moving. All right, one sec, we're froze here. Let's go back to the main screen for a second. See why we're frozen. All right, I think I'm going to have to adjust this portfolio offline. The paper trading right now, I'm not getting quotes. And it's probably because I jump shipped halfway in between. Ah, boom, there it went. Save the day. What we got? We got 5 more minutes. Let's look at this. Charles Schwab, 65 call option. It's trading now 18 by 16. When we did the trade on that is it the 64 that we had here? 64. When we did this trade, so we're a little bit behind on this option contract. We did it for about 28 cents, 29 cents. And now we see it's trading at 36 by 33. So it's not a huge danger, but I want to show that if we do this trade on that expiration, we're going to be buying to close this option contract. And then we would go out to December and we would, okay, put that down below. Buying to close. Still having issues. All right. Sometimes you just got to laugh. All right. Let's see if we can do NVIDIA. NVIDIA is probably a better pronunciation. All right. So in NVIDIA, we now have the December 8th, December 22nd, which is 18 days away. December 8th is 4 days away. We're at 452. Market is down today. What if we go out to 18 different today? 450. We're going to sell the, God, we can go way out of the money in NVIDIA. I'd like to get up above 500. 500 is a support level that's tough to beat. We got December 22nd. We're going to sell something for around $1. We're going to sell the 520s. So if we can, we're going to sell this against our position. We're going to go out till December 22nd. And we are, so that's right before the holiday. And when is that expiration date? What day of the week? December 22nd is going to be that Friday before the holiday. So that's what we're going to sell, December 22nd. We're going to hit the bid on this. Good. Okay, so we're selling one NVIDIA 520 call at a limit price of 90 cents. Good for the day. I think we'll, let's go 89, see if we can get a fill on that. And here's the order. And we're going to add that to our portfolio. And it looks like we filled. All right, so we filled. So we run over to our portfolio. And now we have an 18-day option contract, which is going to match our cap position. And here we got a 15-day option contract. And this one will expire on the 22nd. And we were able to get that done for 91 cents on that trade. Oh, 89 cents is what we hit right now. Sorry about some of the technical issues that I was having today. But we're going to leave that the way it is. If you have any questions, please put them in the chat box, and I will try to address them. We'll come back on Wednesday, and we'll look at that Schwab position. Market did come down today, so that's a kind of a good thing. No real panic on that position. We didn't quite get to 64. If we get to 64, we can go a little bit beyond. If it goes to 64, 64 and a half, 65, we can still roll the call for usually a decent net credit to the account going out a couple of weeks in time. You would go up and out and strike. The market's selling off a little bit today, and that has helped our call position on Schwab, but obviously that hurts our deep in the money option contract. But that position is still up, still doing well. So with that said, that's it. Thanks for coming, everyone. Please click subscribe, ring the bell, and we'll see you this Wednesday for the next edition of Options Guy TV.